Hello and welcome to GetRicherQuicker.net. Today we're going to talk about mortgages on personal residences, and this has been updated for the Tax Cuts and Jobs Act of 2017, Trump's tax law that he got passed through Congress and signed into law in December of 2017. It's been around for about a year now. Now, mortgages are a way to borrow yourself into home ownership. Typically, the average homeowner does not have the entire amount of cash to put down on a home. You buy a $200,000 home, you may not have $200,000 of cash. What you typically do, you go to a bank and borrow the money. Some cases you may borrow from a relative, a parent or something. Then each month you make payments to the bank of principal and interest. The principal goes to pay down that loan amount. Now, payments may also include real estate taxes, homeowners insurance, mortgage insurance premiums. Some banks require you to make those payments to them, others don't. And by the way, please feel free to email me at jkhcpams@aol.com with any questions you have on this topic or any other tax-related topics. I'll be glad to get back to you. The amount of interest on acquisition indebtedness that is tax deductible is dependent on when you took out the loan. Loans before October 1987, there's no limit on the loan. In other words, if you took out a $5 million mortgage, you could deduct the interest on that $5 million. Now, 1987 was 31 years ago. Typically, the mortgage on a home is for 30 years, so I don't think we have too many of those around anymore. Loans obtained after October 13, 1987 and before December 16, 2017, the limit is $1 million on the loan. The interest on the first $1 million is tax deductible. If you get a $2 million mortgage, the interest only on the first $1 million is tax deductible. Loans obtained after December 15, 2017, only the interest on the first $750,000 of the loan are tax deductible. Now, limits apply to your personal residence and one other residence. If unmarried, co-owners jointly own a home, each can use the applicable limit in acquisition indebtedness. For example, you have two unmarried individuals purchase a home in 2016. Remember, the ceiling is $1 million back there. The mortgage is $2 million. Each can deduct the interest on $1 million of the loan. There are special limits that apply to distressed homeowners, which we're going to talk about a little bit later. Conditions. For interest to be deductible, 4 conditions must be met. Acquisition and indebtedness cannot exceed the limits we explained in the previous slide. That's the $1 million, $750,000. The loan must be secured by the residents. Deductible interest on no more than 2 residences, and you must personally be obligated to repay the debt. Acquisition indebtedness is usually the mortgage obtained to buy, build, or substantially improve a home. If the loan is to construct your home, some people like to build their own homes, only the interest paid during the 24-month period, starting with the month in which construction begins, is deductible. Interest paid before the 24-month period is not acquisition indebtedness. It is considered non-deductible personal interest. Same as credit card interest or interest on a car loan or boat loan. For example, May 2018, you buy land to build your dream home and obtain a construction loan in June. Construction begins in September 2018 and is completed June 2019. On your 2018 tax return, you may deduct the interest starting with the September 2018. Since construction was completed within 24 months, the interest is deductible. If a loan is taken out within 90 days after the construction is completed, it may still qualify for acquisition indebtedness to the extent of the construction expenses incurred within the last 24 months before completion of the home, plus expenses through the date of the loan. Now, this stuff is a little complicated. There's a lot of material right there. So please feel free, come back, look at these slides again if you're in this situation. If you decide to build a home, you want to make sure that you get the full benefit of deducting that mortgage interest. Debt secured by the home. Your mortgage must be secured by your personal residence for the interest to be deductible. Secured means the loan is recorded in your designated recording office. Now, different states have different rules on where the mortgage needs to be recorded. I'm in Central Jersey. It gets recorded in the county courthouse. So the loan has to be recorded wherever your state or locality requires that the mortgage be recorded. The recording of that mortgage gives the lender the right to foreclosure on your home if you do not repay the loan. In other words, the lender, the bank, can take your home if you don't pay on the loan. Two-resident limit. The deduction for mortgage interest is limited to 2 homes, your main home and a second home. If you own a second home and rent it, there are complicated rules. Now, as far as your second home, this could include a boat as long as you have certain things. As long as you can sleep on it, you have toilet facilities, you could deduct that. So don't think it has to be a stationary home, like your principal residence. If your principal residence happens to be a stationary home built on land, okay? Personal liability. To deduct the mortgage interest, you must be personally liable to repay the loan. If your parents take out the loan, even if you repay it, you cannot deduct the mortgage interest. And there's some special rules on that. If you have questions, please feel free to email me. Distressed homeowners. A distressed homeowner is someone at risk of foreclosure. The IRS has created a safe harbor which runs through 2021. Now, that safe harbor is somewhat detailed. I can't go into it here because I like to keep these things brief. If you have a question, please drop me an email. Limitations. You cannot deduct mortgage interest if you take the standard deduction. You must itemize on Schedule A. Now, we know with Trump's new tax law, there were a lot of changes with the Schedule A, so you have to make sure that you're still going to use the Schedule A deduction. Points you pay to obtain a mortgage may be deductible. Special rules on that. Other costs to obtain a mortgage are not deductible. In other words, you got to pay the lawyer, you got to pay the title company. Those expenses are not deductible. Married filing separate have limitations of 1/2 of single or married filing jointly. I like to keep these brief. I like to hit the main topics because this stuff can get very complicated. If you do have questions, I know right here it says John at GetRicherQuicker.net. I don't have that set up yet, so please feel free to email me at jkhcpams@aol.com. Thanks and have a great day.